Good morning from London. You're here for today's FS Club webinar entitled The Financial Risk of Nature Loss. My name is Simon Mills and I'm the lead consultant at Zien. And in a minute, I'm going to guide you through this morning's proceedings and introduce you to our guest speaker, Dr. Nina Seeger, the Research Director for Sustainable Finance at the Cambridge Institute for Sustainability Leadership. But before we begin, I'd just like to offer a word of thanks to our sponsors who not only give us the brief to wander through the halls of politics, economics, science and history, but also allow us to open them up to the public. If you'd like to know more about the FS Club, do drop us a line. Now, the format for today's webinar is quite straightforward. You're going to be shot of me in a minute and hear from today's star turn, Nina. Following her presentation, there's going to be time to explore some of the issues she raises in more depth. And this webinar is going to be recorded, so you can always revisit it or indeed any of our previous webinars on our website. If you've got any questions you'd like to put to Dr. Seeger, please use the conversation tool on the right-hand side of the screen. I'm going to be consolidating your questions during her talk, and I will put them to Nina at the end. And so to today's speaker. Nina is a leading light in the field of sustainable finance, having worked in this field for numerous financial services organizations, as well as advising the South African National Treasury and Banco de Mexico on environmental risk. In addition to her role at the University of Cambridge, Nina is an academic visitor at the Bank of England, as well as a member of the Strategic Advisory Board on Sustainable Finance at the British Standards Institute, the Sustainable Finance Scientific Council S&P Ratings, and the Board of Directors at the Global Research Alliance for Sustainable Finance. Nina, please tell us about the financial risks of nature loss.
Wonderful. Thank you very much for such a kind introduction, Simon. I'm just waiting for the prompt to start my slides, if you allow me 1 second. Wonderful. Thank you very much. So my name is Nina Seeger, and I am a research director responsible for sustainable finance at the Cambridge Institute for Sustainability Leadership. We're a think tank within the University of Cambridge, and as such, we do some of the things that university departments do, such as research and education, though mostly postgraduate and executive. But we also do some really interesting things, such as we have our own accelerator and we convene leadership groups. Within the Center for Sustainable Finance, we convene 3 groups, climate-wise, our group of insurers, investment leader groups, where we work with investment managers and asset owners, as well as the Banking Environment Initiative. And across those 3 groups, we work with over 50 large global financial institutions to drive sustainability into the mainstream of the financial system. We have been working in the area of environmental sources of risk for many years. We were a knowledge partner at the G20 Green Finance Study Group way back in 2016. And really from then, we've been working towards getting a better understanding of nature-related financial risks. And currently, we're leading a project with both our Banking Environment Initiative and our Investment Leaders Group to understand the materiality of nature-related financial risks and to see what we can take further within the nature finance. Before we dig a little bit deeper into this, by the way, please don't try to read the slide. Just look at the pretty colors. Look at the prevalence of green. This is the World Economic Forum 2021 Global Risk Report. What you see here are the top global risks in terms of likelihood as well as in terms of impact. You see that most of them over the last 5 years have been environmental. What that tells you is that the business leaders worldwide are fundamentally worried about how do we start thinking about environmental source of risk, be they climate or biodiversity, and how do we incorporate them into our daily thinking. In terms of kind of taking another step back and thinking about natural capital and ecosystem services, so why and how does nature matter? We know that 75% of land is now degraded. We know that effectively there is an estimation of $10 trillion of economic losses coming in by 2050 due to the decline of ecosystem services. So we talk about natural capital as the stock of renewable and non-renewable natural resources, so plant, animals, air, that effectively combine to yield a flow of benefits to people. We bring that into understanding the flow of services, which are the benefits all of us obtain from natural capital. So material outputs from nature, water, fiber, regulating. So how does nature provide water filtration services, storm protection, pollination, as well as a variety of cultural and supporting benefits? How does finance fit into this picture? Effectively, we have seen work that demonstrated that $44 trillion of economic value, or about 50% of global GDP, is moderately or highly dependent on nature. And you can see some of the sectors that are moderately or highly dependent on nature in this graph on the right in red or in dark orange. But interestingly, only $143 billion of finance flows towards biodiversity conservation. And what's even more interesting, $542 billion is spent on subsidies harmful to nature. Let me take you through a very short example. If we think about the Amazon and the Amazon reaching its tipping point, its biodiversity tipping point, and potentially moving from the rainforest into a savanna, the cost of that would be $256 billion. However, the policies to avoid it would generate $339 billion. What I'm trying to say here is that nature and finance is completely intertwined. However, what we're currently not doing is finding a way to account for nature in our mainstream financial risks. So what has been happening on this front so far? We've seen quite a bit of momentum around nature and finance picking up. So this summer, we have seen the grounding of the Taskforce of nature-related financial disclosures to be following into the footsteps of the TCFD, of Taskforce for Climate-related financial disclosures. We've seen some really interesting work by the Dutch Central Bank looking at nature-related financial risks of the Dutch financial system. We have also seen the Dasgupta review of the Economics of Biodiversity, a seminal piece that looked at the importance of biodiversity to our wider economic system and to our development at large. And as we speak, the Network for Greening the Financial System, the major network of central banks and financial regulators, had set up a study group to understand the relationship between biodiversity and financial stability. It's a study group on which I sit. So we're looking at, there's already been a report published, but we're looking at a lot more coming out. So there is understanding and knowledge coming about this, and there is momentum building up in nature-related finance. But how does business and finance fundamentally relate to nature? If you look at a corporate view, there are effectively three ways that a corporate is impacted by nature, and that is either via its operations, or via the risks that sit on their balance sheet, or via the opportunities generated by nature-related finance. Now, if you take that one step further and talk about financial institutions interact with nature in two ways. Firstly, from its own organizational perspective, i.e. starting to integrate nature-related risks into their everyday perceptions, or from the client and investee perspective, so supporting their clients and investments in moving towards a nature-positive world. We've spoken about the organizational the risk, and the impact of our investments. So within the organizational world, we see corporates starting to develop corporate biodiversity strategy. And our business and nature team has been helping corporates to do exactly that. We also see how different corporates are looking to understand the impact of their activities on nature. And there are two ways to really measure impact. The first way is to look at pure play corporate impact. So if you understand your supply chain, if you understand kind of how biodiversity flows through that supply chains and how it's affected by activities on the ground, then you can start calculating impact on the basis of that information. However, you can also go much further and much higher. So at CISL, we have developed a sustainable investment framework that had summarized 17 sustainable development goals into 6 impact themes. And in terms of nature, we have an impact theme called healthy ecosystems, which looks at how can you understand the impact of any investment fund. So we're not just talking about the narrow impact investment, but the wider universe of investment funds. How does that fund actually impact onto the nature, onto climate stability, decent work, and well-being? Now, having spoken about the different ways organizations interact with it, now let's dig a little bit deeper into financial risks. Nature loss is a source of financial risk. We have spoken about how 50% of our global GDP is dependent on nature, which means that nature presents both physical sources of risk as well as transition and liability sources of risk. And that is classification that is widely used in the climate space. And we'll talk through how that happens on the effectively just a little bit later. So if you think about the flow, you've got the sources of nature-related financial risks, which are physical, so actual nature loss, transition, the activities undertaken to stop that nature loss, or liability, the litigation that comes with. Via 6 different transmission channels, these sources have an impact on companies, households, and financial institutions. It can go via disruption of activities, for example, a landslide disrupting a transport system, via raw material price volatility. So effectively loss of pollination services affecting food prices, affecting soft commodity prices. Pricing externalities, so taxes on nitrogen fertilizer driving down water pollution, adjustment or relocation of activities, looking at deforestation, or looking at effectively when something happens when we're building on floodplains, stranded assets leading to premature write-offs, and capital destruction. Financial institutions are exposed to this via loans, debt, and/or equity holdings, as well as by declining revenues from financial services. Also, quite obviously, financial institutions are organizations, and therefore, if nature loss impacts operations or property, that's another way to bring it into the financial risk scope. So effectively, via these transmission channels, you have impact on companies and households and financial institutions, which present risks to the financial institutions. And that in turn might lead to risks to financial stability at large, which is why the Network for Greening the Financial System is currently considering how biodiversity and financial stability is effectively related. So let's look a little bit deeper in terms of what kind of risks we're actually talking about. So this is a framework that we have developed together with our Banking Environment Initiative and Investment Leaders Group clients. You've got 3 types of risks. Physical risk, these are ecosystem services which are at risk due to climate change, invasive species, land use change, overexploitation of natural resources, as well as pollution. The decline of these ecosystem services in terms of leads to the decline of air quality and local climate, food and other goods provision, habitat intactness, hazard regulation, and water security, which impacts on companies via the transmission channels that we have described. In response to nature loss, we then have transition risks manifesting. So we've got new policies and regulations coming in. We've got potentially new technologies developing, for example, new proteins to address with the problems that we've got on the food chain. We've got new business models developing, as well as the consumer and investor sentiment. And obviously, there is also litigation risk that can flow through. Now, this brings us into the resultant financial risk. So, for example, if pollination services are disrupted, then you can have an impact on market prices of soft commodities, bringing you into effectively a market risk. If you've got issues with flooding, which impacts your mortgage portfolio, that brings it into your credit risk. And then there are viable examples of the same happening within the liquidity as well as within the business risk scope. Now, if we think a little bit further, we get a lot of questions about, well, how does climate and nature come together? Obviously, this is the year, so 2021 is the year of the climate COP in Glasgow. However, it's also the year of the currently segregated into two, the biodiversity COP in Kunming. So when we're considering climate-related financial risks, we often hear about nature being offered as a way to combat some of those. And we need to think about those in concert together so we can build a climate neutral as well as a nature positive economy at the same time. Because if you only think about addressing climate change, then when you are thinking about reforestation, you're not taking into account the kinds of species you're putting to the ground in terms of trees and what kind of biodiversity effect or impact they might have. So we need to think about solving these two problems in concert. And on the other hand, within the nature loss space, climate effectively has a worsening effect. It's not the biggest driver of nature loss. Arguably, land use change is. However, it impacts on all of the other drivers and exacerbates them quite substantially. So, in effect, without moving beyond looking at these two issues in separation, dealing with climate first, and then when we get around to it, addressing nature, we need to think about it in concert together. Now, we've also seen some financial organizations not only looking at financial source of risk coming from nature loss, but also putting together, looking onto the opportunity side of the coin, bringing together new funds and new commitments, enabling more of that financing flow to go towards nature restoration. So what next for nature-related finance? We're seeing right now how biodiversity loss is going from a pure play reputational risk into a viable financial source of risk. We are also seeing that this year we've got the biodiversity COP in Kunming. We're seeing new potentially biodiversity targets emerging. And some organizations are already putting potential biodiversity targets for the financial space. So, for example, biodiversity targets for banks. We have also seen, for example, if you remember, France was a leading light in terms of putting disclosure, climate disclosure into regulation by Article 173. Well, now we've got Article 29 in France, which is looking at financial institutions disclosing around biodiversity and biodiversity-related financial risks. And there we see the development of an interest to transitioning to a nature-positive world, creating opportunities for financial institutions, as well as advancement in technologies and moves in the investor and consumer sentiment enabling this change. So thank you very much for listening to me talk about nature-related financial risks. And I would be very much looking forward to answering your questions. And if you've got any other questions, do please feel free to reach out to me.
Wonderful, thank you. That was absolutely fascinating, Nina. We've got a host of questions from our audience, but I'm going to take Chairman's privilege and ask the first one. And what I am going to ask is, actually, hold on, I've got an issue I did want to raise, which was on the risk factors you put in there. I think there is a particular category which is worth looking at, which is societal risk. Because a high quality environment actually reduces chronic illness, it enhances mental health, and it reduces low level crime. So from a public policy perspective, there are significant advantages to having a high quality environment and natural systems, because you're actually reducing public expenditure.
That's a very, very good point. And effectively, the argument you're putting forward is the cost of inaction argument, which
Absolutely.
has been used quite effectively to bring climate action into question as well, because effectively, if you measure the impact on public health on our NHS of pollution, then it becomes a much easier debate to look at investment both in climate and into nature.
Absolutely. Right, okay, Chairman's privilege, first question. Quantifying and capturing the value streams associated with natural capital can be really, really challenging, because whilst the concept of biodiversity is really well established, its measurement has yet to be pinned down in the same kind of way that when you're talking about climate change, you can measure carbon emissions. How can this issue of data actually be resolved so that you can get meaningful measures incorporated into financial risk assessments?
Simon, it's a very good point. And, very famously, we only manage what we measure. And in this sense, nature is infinitely more complicated than climate. With climate, we have one thing that we have to optimize on, and arguably climate in comparison to nature is really easy because we know exactly what needs to be done. It's just difficult doing it. Whereas with nature, it's a collaboration of many things. We can track soil health, we can look at water pollution, we can look at abundance of species, but there's never going to be one single thing that unites all of these into one nifty little metric. We've tried doing that with the Sustainable Investment Framework. And what we ended up with is at that point, we did base metrics and ideal metrics. And base metrics is what you can measure now, whereas ideal, what you ideally want to see. And effectively, on the one hand, you can look at the use of water, but what you actually would like to look at is the area of degraded land. So in all honesty, what we're going to have to do is get several types of metrics and start tracking them. And that is already possible. So there are certain metrics that are being tracked. There are impact metrics out there that can be followed, that can be looked at, as well as, and I'm trying to think to make this point quite seriously, at this stage, we are getting through the materiality conversation for nature. It's thinking through, okay, this is a financial risk. This is the material financial risk in our portfolio. We see this done for the first time by the Dutch central bank. We see it being contemplated by the French central banks, as well as potentially at some point by the Bank of England. we need to start measuring it. We need to start writing use cases and scenarios and actually demonstrate it, how this is material in our financial institutions. And we're doing some of that work, and we'll be publishing them in October, hopefully.
Oh, I have got an excellent question here, which is, what do you see as the limits of scenario analysis when it comes to physical risks and financial stability, given the existence of these tipping points? We're hearing a lot about the moment about tipping points in climate change. So how do you actually factor tipping points into scenario analysis?
Tipping points are really, really key, obviously. I mean, and this is probably in reaction to the IPCC report, which has once again brought into our attention the fact that we need to amplify our action on climate quite substantially, as well as start thinking in a material way about adaptation. Scenario analysis has its place. A lot of the great benefits from scenario analysis come from contemplating different versions of futures. So less than thinking through particular numbers that it's throwing out, but more in trying to understand the variety of outcomes and the variety of problems that come out. And I wonder how much of the insurance industry's natural catastrophe models. I mean, they've got an absolutely amazing capability, which they've been using to understand physical source of risk, which are actually quite close to nature sources of risk. How much can we use that to actually start getting a grip on those?
I think that's a very good point. When I was at the City of London Corporation, I put together a climate change adaptation strategy for the city. This was back in 2004, so it was very early days of climate change adaptation. And the method that I approached this from was talking to service delivery managers, and instead of saying this is what's going to happen, I was saying to them, okay, you run housing services, what would happen if you had increased flooding, there were heat waves? What impact is this going to have on your service, and how are you going to overcome it? So it's actually getting the people at the front edge in service delivery in business to actually contemplate at a local level what the impacts of climate change are going to be. It's, you know, people have got difficulties in grasping the concept of climate change at a planetary level, but if you ask them, you know, how would a flood, how would a heat wave, how would high winds affect you in your service delivery, in your business, then they've got a much better grasp of what it actually means. So that's a, you know, that's a really interesting point. Now, I have two interlinked questions here, but I'm going to put them separately. The first one is about the short-term nature of markets. How do you actually maintain interest in propositions which aren't going to see a tangible result for 10 or 20 years? You know, if you're talking about investing in ecosystem services, in natural capital protection, how do you actually engage that interest over the long term that's required?
I mean, this is a fascinating question. It comes at the crux. We tend to think about nature loss as well as actually climate problems as something that comes on a distant horizon, something that's not here already, and that's not quite right. So I'll start with climate and I'll follow it up with nature. In terms of climate, we're looking at 1.5 degrees warming in 9 years' time. What that sometimes means is there's some really interesting calculations that say that under 1.5 degree warming, the UK will see an increase in economic damages from flooding going up by over 1,000%. Now, show me a financial institution that has modeled over 9 years changing in their damages calculation, increasing to that stage. In the same way, we see nature loss today impacting and sitting within our financial portfolios. What we're not seeing is actual calculations of where that is coming through. we tend to have this cognitive dissonance between nature is out there and it's pretty and it's beautiful, and what I do in my day-to-day work has nothing to do with it. And that comes from the fact that when we have been setting up our mainstream economic models in the wake of the Second World War, what we got to was what was important at that point was the built-up capital. So by effect, we had ignored most of the natural capital in those quantifications. And the unintended consequence of that is that we have completely lost sight that we live and we base our economic system fundamentally on services that nature provides every single day. So what that means is our food system has massive risks baked into it already. And if we're not understanding them, if we're not measuring them, if we're not managing them, it's not something that's going to come to bite us in 20 years' time. It's something that's going to come bite us in less than 5, probably.
Absolutely. And I think one of our problems is our analysis seems to be retrospective. So we're modeling the future on what's happened in the past. And, you know, if you're looking back for climate models for the last 50 years, that is not what's going to happen in the future. So, you know, I think that certainly that needs to be given consideration in modeling science. Now, the related question is how much notice is business taking of this? So, you know, we've been ringing the alarm bells. Is business sitting up and taking notice?
And that was one of my worries at the start of the COVID crisis. So my major worry was that, you know, COVID hits, organizations get limited budgets. That budget in terms of sustainability is going to get spent on climate. Nature is going to drop off the conversation. We haven't seen that happen. We do see a lot of attention flowing, very rightly flowing into the climate world, into the climate emergency space. However, we see a lot of interest and a lot of activity in the nature space. So effectively, we've had amazing engagement from the banks and investment managers, and we're starting to see quite a bit of interest in this from the insurance companies as well. So I think there is conversations ongoing. I think action is more difficult as it tends to be, but I think there's a lot of thinking and a lot of materiality level conversation starting to happen within the financial system. And I think there's one more tiny difference between how I have seen the climate conversation develop versus how I'm seeing the nature conversation develop. So the climate conversation for a very long time was driven by the corporate space. I see a lot more activity comparatively, a lot more activity a lot earlier in the financial space within the nature space.
That's yeah, I tend to agree with you, because certainly even as, you know, a shorter time frame as 3 years ago, nature was not actually considered a germane issue, but it's certainly beginning to gain traction now, and that is incredibly rapid in this space. Well, we've worked in the same field for a long time now, and you know, it's taken 20 years to get where we are now. I think nature will catch up very quickly. This is an interesting question. Do you think there are any sectors which are immune to nature-related risk, or is this something that every sector has to be concerned about?
One very quick comment on your previous comment, if I may, before I answer this question. So absolutely, and also, you know, we shouldn't discount the huge swathes of research that has been an understanding that has been done on this within the biodiversity and the nature space. It's just that up until probably about, I don't know, 5 years ago, it hasn't been translated into the financial world in quite the same way as it is translating now. Now, in terms of whether any sector is immune from nature, I don't think so. I think we are vastly underestimating the effect of that nature has on most sectors. And if you look, I think the closest sectoral approximation that I have seen so far was that sector dependence matrix. Most of the sectors are dependent in some way, shape, or another, and I think some are dependent in a much more stark way than anybody had anticipated.
Oh, right. Okay, hold on. There's still more questions coming in, and I'm trying to field them at the moment. Let's have a look. Right. What suggestions have you got to bring the pain of second order effects of poor environmental policy into the short term? So how can we actually improve short-term incentives?
It's a very good question. Something that was done quite in the early days of climate was looking at the analysis of how various incoming policies would impact credit scores of potential corporates. So effectively going a little bit back to scenario analysis and saying, if we've got particular water pollution policies, air pollution policies coming in, what would that do to my credit ratings? What kind of credit migration am I going to expect? The one caution that I would put is if we are conducting scenario analysis, it needs to be quite a comprehensive one. What I'm not a big fan of is we take, a portfolio slice, which is about this big, and we go, well, in this little portfolio is affected in this particular way by this little thing. If you're doing a scenario analysis, and let's say if you're running a flood scenario, you need to think about how will your portfolio be affected? What kind of unintended consequences will this flood have? How will your operations as a financial institutions be affected at the same time? Where are your assets located? Because effectively geolocation is a huge issue within the nature space. Otherwise, you may end up like that very famous case of a massive financial organization that sat in New York, fully powered up, through the flood, but with not a single employee being able to get to it because none of the infrastructure around it was working.
I think that another thing to consider, I think you can do heat mapping of your portfolios and determine whether the risk lies, but I think you also need to think about how you are creating risk, so the impacts that your investments actually have. But it also brings me on to an interesting piece of research which I'd recommend to everybody, which is policy performance bonds. We've done a little bit of work on this as Yen as a thought experiment, and the idea behind a policy performance bond is you are borrowing money which is tied to performance in particular key areas for policy. So let's say, for example, you're a government, you can borrow money through standard gilts, but if you fail to hit particular targets with regards to nature conservation, the interest rates that you pay are higher, and you can do this in the corporate space as well. So I'd recommend have a look on the Long Finance website, and there's some interesting research on there looking at policy performance bonds. Now, I have got 5 more minutes before we head off. And I
Simon, as you're contemplating your next question, can I make a quick comment?
Yes,
I
of
think
course.
another important thing is thinking about the financial industry in concert. So if we go back to our flooding example, and you've got a portfolio of properties, and you look at it and you go, that's all right, and you're a bank, and you look at it and you go, that's all right because I've got insurance coverage for that stuff. So I'm all good. I'm all okay. I'm all protected. I am impacted, but my risks are low. What is important to think about is that if you're an insurance company and you're insuring a portfolio of potential assets, when that thing rolls off in 12 months' time, you have the option to either increase pricing or pull out of providing insurance. So you need to think about the kind of the consequences on the financial system level and who owns the asset and who's going to be left sitting with that asset on their balance sheet, and who's able to actually come out of position and trade out.
Now, I've got a decision to make here. We can go with an easy one or a hard one, and I know we've only got about 3 minutes left. So which one do you fancy, Nina?
It's up to you. I can go with a hard one, or you can ask both, and I can try to answer them both in 3 minutes.
Okay. Well, let's go with a hard one then. Although nature loss has got a profound impact on the economy because ecosystem services are public goods, they suffer from the tragedy of the commons. How can we capture the value streams arising from the natural environment? And how do we resolve some of the ethical issues that arise if we're commoditizing nature?
So effectively, the hard one. Look, yes, nature is a public good. However, it is also something on which we're fundamentally reliant on to produce goods. So it has to be reflected in our financial risk chain. So effectively what you're looking at, if you're looking at the agricultural services, and I don't know if any of you are watching Jeremy Clarkson's The Farm, right? Weather out there is unpredictable. However, it has a very particular effect on our farming industry. So you need to think about how do we take things that we depend on and reflect them adequately in our mainstream financial calculations, because then what you can do is you're then going to be able to track that and actually adjust and manage those risks. Whereas right now, by taking it's a public good, I'm not quite sure I can do anything about it. Effectively, we're leaving an unmanaged risk out there, able to wreak havoc with our economic system at some point.
And I think that is an incredibly important point to leave our discussions on. Nina, thank you so much for a fascinating and insightful chat today. Unfortunately, time has flown and we've got to say goodbye. There's just time once again to thank our sponsors. And if you're minded for further enlightenment this week, we have two further events. One is tomorrow, which is looking at how COVID might actually change the face of capitalism. And on Thursday, you can hear about hot topics in employee share ownership programs. Find out more on our website. Dr. Seeger, ladies and gentlemen, thank you so much for coming today, and we hope to see you again at another FS Club webinar. Thank you.
Thank you, Simon.